Coming up, unpacking Neal Bawa's top 10 irrational investor objections and the truthful response. It's a coaches only session as we dive in with yours truly. But first, a tasty musical treat from Jacksonville's very own Firewater Tent Revival. Hello, Jacksonvillians. I'm your host, Ian Brown, and this is the Jacksonville Commercial Real Estate Show, where we bring you dynamic entrepreneurs, deal makers, and thought leaders ready to dive deep, unpack the local commercial market so you can invest with greater confidence and accelerate your own success. This show is lovingly produced by yours truly at Yield Coach Capital. To stay up to date on Jacksonville's nuanced commercial real estate market, news and events and opportunities for investment, go to investwithacoach.com. Answer a couple of questions and join the team. In exchange, we'll send you 107 questions to ask a deal sponsor so you'll be armed and dangerous when underwriting your next real estate investment. All right, guys, today's a little different format. It's just me. We're going to do a solo episode. I recently went to Raisefest in Phoenix, Arizona, which is a conference for capital raisers for commercial real estate. And one of the speakers is a national speaker, Neal Bawa. He is founder of Grocapitus, which is a private equity multifamily fund and syndicator operation. He's a renowned speaker, and he provided us with a top 10 irrational investor objections and the truthful response for 2024. I've spent some time. I've seen Neal. I've been through this document. I'm going to share the 10 that he gave us along with his responses. I'd love for you to email, comment in the show notes, message on social media. Let us know what you think of this. These are his thoughts. I'll put a little bit of my commentary into them, but I want to share with you a somewhat counterintuitive position to multifamily investing in 2024. So we'll go ahead and share this with you. All right. The first objection common for limited partner investors that he indicates is, well, I can earn 5% in a money market right now. Why would I invest with you? His response is, that 5% in a money market is going away. The Federal Reserve will probably cut that rate multiple times this year. So you'll be making 4% and then 3% next year. And with inflation, you may make nothing. Plus, you lose the depreciation benefits and the write-off of existing income, and you also pay ordinary income tax instead of capital gains on that money. So how is that a good move? My commentary on that one is I tend to agree. I have some sideline funds parked in a high-yield savings account. I have them there knowing I want to deploy them, but it's not a long-term strategy to leave them in those accounts. You do want to get into an asset where you get depreciation benefits, capital gains instead of income tax, and appreciation of the asset with a rising appreciation across that asset class or in that region. All right, the next one. All my friends tell me that they've had cash calls and no cash flow for 2 years. And when he says that, he means my friends that are limited partners in real estate syndications. All right, his response is, your friends are creating an opportunity for you to make money. Their investments were made when the market was at its peak and properties were overvalued. As interest rates went up and values went down, their cash flows disappeared. And that's why properties today are 20 to 30% cheaper. Their loss is your gain. All right. So he's essentially saying their loss is your gain. Those high peak values have now eroded slightly, and you can get a discount of 20+%. My thought on that, as it pertains to Jacksonville, and as we've heard from John Rutherford with NAI, a guest we had, as well as Steve McAdoo, both in the multifamily space, previous guests on the show, we're not seeing big slides in valuations. We are seeing some cap rate expansion and a little bit of rent compression, but it has not resulted in big swings in value in Jacksonville. I will say there are some people pricing assets a little bit more aggressively now than they were a year ago or 2 years ago. And I think there's certainly less competition, at least at the time of this recording. So there can be an opportunity to gain some discounts in Jacksonville. So I do tend to agree with that comment. Next, multifamily values are going down, not up. So why should I invest? The exact same argument was used in 2008. Read any book on investing, and it tells you that you're much more likely to make money when you buy during a down cycle than during a peak. How are discounts possible in an overvalued boom market that investors were throwing money at 2 years ago? This is a fairly commonly held concern. People ask me this question relatively often. When should I invest? Should I sit on the sidelines? Aren't values going down, not up? Why would I invest in an asset that's going down? Looks like Neal's point is, these down cycles, which what we're experiencing now is not all that extreme from a valuation perspective, but these down cycles are generally short, they're quick, they're concise, and then you have these longer growth periods. If you look at the previous recession, it really crushed values from about 2009. By 2012, most markets were starting to have increasing property values, some sooner than that. And most markets by 2017, 2018 were actually already at or above peaks before the 2008 crash. So I tend to agree with that particular comment. So the next one, objection. I read there is a $1.4 trillion cliff coming for commercial real estate. Neal's response, yes, but that's less than 100 billion of that cliff applying to multifamily. Bear in mind, Neal is a multifamily specialist. And of that 100 billion, roughly 3 to 4% of the value is multifamily in the United States. He's not saying there is not an impact. There is, but the impact is giving us the discounts. Every market expert is projecting that by the end of year 2024, prices will hit bottom as multifamily portions of debt cliff fade and the new cycle starts. You hear a lot about the debt cliff. You hear a lot about these maturities. I've said it in previous episodes. One big thing to watch is, how do lenders treat these maturities? Is it going to be an extend or modify or workout scenario? Debt workouts were very popular, but a lot of banks took properties back and sold them at deep, deep discounts. Was there a lesson learned from 2008, to 2013? Are banks going to behave that way again? That is some of it to be determined. And Neal's point is, multifamily is not going to be a huge segment of that, and it sounds like he has faith in that asset class. So I'm going to say I'm kind of neutral, or maybe a little skeptical on that one from Neal. I think we do need to watch that 1.4 trillion cliff coming in commercial real estate. However, I tend to think, like I've said in other episodes, there will be an appetite for modifications and workouts. So I think if you're an investor waiting for dead fish, I just don't think there's going to be enough of them to live on, to feed on. There will be some dead fish, but if you make your living transacting in multifamily and you're waiting for those dead fish to float to the surface, I think you might be waiting a while, and there might not be very many of them. All right. His next objection that he commonly hears: what if I invest and prices go down another 5 or 10%? To that he says, even the greatest investor in the world, Warren Buffett, would never try to figure out the bottom. His technique is to start buying when things are cheap and keep buying as they get cheaper. This way, his investments are averaged between cheap and the bottom, both of which are great scenarios. Every other great investor says the same thing. No one can time the bottom, even you. This one I agree with. So I heard a nice thing at the conference, easy thing to remember. You want to buy as things are going down. You don't know when the bottom is. You keep buying through the bottom, although at the time you won't know that's the bottom. And then as they start to come up, you buy until you think they're getting too expensive. And if you chart that, it creates a smile. And so you want to buy through a smile. And I think that right now is an excellent time to take advantage of that smile, kind of buying through the bottom analysis. All right. Next objection. I'm afraid of cash calls. Well, maybe you and other investors should have invested 2 years ago when properties were selling for 20 to 30% more than their value. At this point, almost every property has a fixed loan on it. The chances of cash calls are a lot lower. Wouldn't that make it the right time to invest when chances of adverse events are lower than before? So Neal's point here, a lot of loans now, people have gone to fixed. There was a lot of bridge or floating or quickly maturing debt right at the peak, roughly 2 years ago. So the cash calls now, I would agree, are less likely because of the nature of the debt. And I do agree you tend to get some discount now. And people are pricing in fixed debt and existing NOI and existing cash flow and existing debt coverage ratios, that's a lot more critical to the underwriting than I believe it was 2 years ago when most things were pro forma. Next objection. What if interest rates do not come down? Neal's response. Over the last 80 years, there's no evidence that interest rates will stay up if inflation goes down. The Federal Reserve wants to reduce interest rates as quickly as they can. 20 months ago, inflation was at 9.1. Today, 3%. The high rate interest rates have done their job, and it's now time to bring them down. Well, we'll see. My comment on that is I believe we're still going to see more conservative underwriting, conservative pricing, and a little less of this constant 5-year pro forma optimism. I think you're seeing a lot more in place underwriting versus pro forma. So I'm going to say I have some contrary opinion to that one. His next one. I think I'll just buy my own single family rentals instead of multifamily. Bear in mind, the speaker is a multifamily syndicator, so it's a multifamily angle. His response. Since interest rates started going up, the multifamily industry, which has a very prudent banker, started to see loan values slashed, which resulted in prices smoothly declining by 20 to 30%. Single family properties are up 1% over the last 18 months. So which one do you think is overvalued? I know I kind of botched and mumbled that one a little bit, but the point is looking at which asset class is maybe more overheated. His argument, and he elaborated this during his presentation, his argument is that single family is far more overheated than multifamily because essentially of the break between income and value. And that's not part of this presentation that I'm working through, but that was a strong argument. So his point, multifamily is less overheated than single family. He wasn't very bullish on single family. All right, next objection. The federal debt is crazy high. The dollar is losing its dominant position. Republicans are claiming election fraud and Democrats are leaving the border unguarded. Why would I invest in such a crazy world? All right, his response. It's been a crazy one for decades. Read the news from the 90s or the 2000s, and you'll notice two parties were in Armageddon mode back then too. The United States' recent energy dominance means that it actually needs the world reserve currency a lot less than it did 12 years ago. And we remain by far the technological mecca of the world. Our position is stronger than social media clickbait makes it out to be. In the end, investing is about tuning out the noise, not drowning it. All right. I would tend to agree with Neal's position on this. There is so much clickbait media right now. It is hard to cut through the noise. And I think as you look back into decades prior, although the form of media was different, primarily just television and newspaper, there's always been hysteria, especially around an election year. So I don't expect that to tone down. All right, last one. What if inflation goes up again? The vast majority of investments today are using fixed debt. If inflation goes up in the future, you would be a beneficiary as the mortgage would be fixed, but rents would spike with higher inflation, just like they did in 2021 and 22. Why are you afraid of this scenario? So to Neal's point, inflation, when you're in real estate or hard assets, can be your benefit. And especially when you have fixed debt and you have rising rents, that is going to be a value creation. So I tend to agree with that. Overall, of Neal's 10 points, I'm more aligned with his thought process than not. He may be a little more bullish than I am. We may actually be selling our primary multifamily asset in 2024 and looking for higher yield opportunities. I think multifamily as a segment is still very investable. And I do think that those that are willing to do the work in 2024 are going to enjoy lower competition. I won't say a lack of competition, but lower competition. So, all right. Well, that was Neal Bawa. He is the CEO of Grocapitus. And for those that haven't heard of him, he's a regular speaker at a lot of your big commercial real estate events. So wanted to share that top 10 irrational investor objections and what he calls the truthful response. All right, guys, these solo episodes are short form, and bear with me. I'm not used to speaking this long in a row, so I know I mumbled a few things, but hopefully you got the 10 points. And feel free to give us your feedback. put it in the show notes. You can email it to us. You can email me directly, ian@yield-coach.com. Or you can hit us up on LinkedIn or social media or YouTube comment. We love to hear what you think of this. I wanted to share this because there is a lot of fear in the marketplace right now. Some of it is founded, but I wanted you to hear Neal talking through the top 10 in his world. All right, guys. Well, that's a wrap on this show. These solos are shorter format. Be sure to rate, review, and follow on whatever platform you're enjoying this. It makes a huge difference for us today. As I mentioned at the top of the show, to stay up to date and never miss an education, networking, or investment opportunity, go to investwiththecoach.com, answer a couple questions, and join the team. If you're into scrolling and see what we're up to, check us out on Instagram, Facebook, LinkedIn, and YouTube under Yield Coach Handle. All right, guys, that's a wrap on this Jacksonville Commercial Real Estate Show. I'm your host, Ian Brown, signing off and reminding everyone to lace up and leave it all on the field. Yield Coach out.